Thank you for joining in another webinar. So today we're talking about borrowing basics. So what are some things that we need to consider whenever we are applying for a credit card or an auto loan? So welcome, my name is Diana Juarez. I work for CSU Extension and I'm happy to bring this information to you. So let's get started. So we have three main objectives. So the first one, we're going to talk about what are some of the things that lenders consider whenever they are extending credit to us? So this is going to be kind of the perspective from the lender and to kind of help us understand how can we better prepare ourselves to get approved for that credit. And then it's really important that we set debt limits. So, what are we comfortable with paying on a monthly basis towards that auto loan or towards that credit card? Because the lender's always going to grant us that money, but that doesn't mean that we're going to be able to afford it. So it's kind of our due diligence to make sure that we are able to make those payments. And then resources that I'm going to provide throughout the presentation. So first, we're going to go through some statements and we're going to see if they're true or false. And so for the first one, if I qualify for credit, I must be able to afford it. Now, this is false. Again, just because we qualify for 10,000 auto loan doesn't mean that we're going to be able to afford it. Perhaps we may be only thinking, month one, month two, I'm going to be able to afford it. But long term, are we going to still be able to keep up with that? And just kind of a guideline for a car. So let's say we are getting an auto loan. The monthly car expenses, it's 10% of your gross monthly income. So this is in total, how much money do you expect on the monthly basis, and then times that by 10%. And for a mortgage or for rent, even for renting purposes, making sure that no more than 50% of your income goes towards that, because that means that if we perhaps are 50% of our income goes towards those home expenses, then it leaves little room to have more flexibility with saving, and we have an unexpected expense. Are we going to put ourselves in a position where we are not going to be able to make those payments? So that's just a guideline again. Getting loan estimates from multiple lenders lowers my credit score. So let's say I'm thinking of getting a loan and I go to three different banks. So let's say I go to a credit union, I go to a regular traditional bank, and then I go to an online bank to see what kind of, for them to give me a quote of how much they're going to charge me for interest, or if I'm going to get approved for that loan. Do you think that's going to lower that credit score? And so this is kind of depends. So generally with the credit score, they kind of take that into consideration if you are shopping around with multiple lenders. So instead of counting 3 separate times, they count it just as one time. Credit reporting agencies approve or reject the person's request for credit. So credit reporting agencies refers to those big 3 national companies, Equifax, Experian, TransUnion. And so for this one's false. So the credit reporting agencies, they just provide the report, which they compile all of our financial information onto that report. And so the lenders have to pay a fee in order for them to see that. But it's up to the lender to make that decision. If I pay off my debt, any late or missed payments on that account will be removed. Now, this is a false statement. Any late payments can remain on that credit report up to 7 years. Again, even if we paid off that loan in full, that doesn't mean that it's going to go magically disappear. It will remain there in that credit report. So it's really important that we talk to our lenders before we get into the trouble of a late payment, because once that information is going to go there, it does have consequences when we are trying to seek a new loan. and they see that they have this information on a report, that's really going to hurt us long term. Now, when making a major purchase, what are some things to consider? So first is kind of doing our homework. What are we seeking? What product? What service? So let's say for a car, if we're looking for a newer car, of course, that's going to be more expensive. But, if we are trying to stay within budget, we have to be more open and flexible on the type of car that we are seeking. So some of my favorite resources to look for information, one of them is called Consumer Reports. So if you have a library card, you have access to this for free. So make sure that you can go to your library and ask for this resource. Because this is, I really like Consumer Reports because they do a lot of research around, what is the best 10 economical cars, what is the best laptop to buy. They do their own research, and companies don't pay them to write a review on them. So it's unbiased research. And there's a lot of online resources. One of them is Bankrate, there's credit cards, NerdWallet. So all of these online resources, you can find information just to help you provide more guidance or more detail as the product that you're seeking or the service. And JD Power has this really cool calculator where you can input, okay, this is the amount of money that that I feel comfortable with paying on a monthly basis. What type of car can I purchase with that? Or, if I'm willing to only take 5,000 loan for a car, what type of cars can I buy with that within that budget range? So that's kind of homework that we can do beforehand. And next, it's really important that we shop around, that we can compare different offers with one bank versus bank number two. So there's traditional banks, there's also online banks, there's credit unions that we can go to see, hey, I'm just trying to find out what type of offer you're gonna present me with, and so then I can make that decision. And next, it's really important that anytime that we are able or have the ability to save for a bigger down payment, that's really going to pay off in the long term. So it's going to pay off in the long term because we're not going to have to pay a lot of money towards those interests. So banks make money by charging us interest rates. And the higher the interest rates, that means that majority of that payment is going towards this interest rather than the principal amount. One of my favorite websites for information is Consumer Financial Protection Bureau. So in this presentation is going to be really broad and general. It's not going to be specific to a specific product or service. So here I really encourage you to find that information. So here they have different worksheets if you're trying to find a car, or perhaps a new car, used car, or a home, or a credit card. They really help you kind of think of all of the details that go into it, because when we are buying a car, we're not really thinking about all of the nuance of, we have to also take into account maintenance, we have to take into account a car insurance, car registration. And so this kind of helps it break it down and make it kind of less overwhelming to make those decisions. Now, when we talk about credit, I think the first thing that comes to mind is when, to borrow money to buy a large purchase. But credit could also mean different services and products that we can get. So some of them is car insurance. So with the car insurance, before they give you an estimate or a quote, they're going to want to look at your credit report, your credit score before they make that offer, and also determine how much you're going to pay for that premium. If, renting. So with renting, also, again, they're going to want to look at your credit report, your credit score before they grant you to be their tenant. With credit cards as well. So most of us, we need to borrow money from the bank to make a large purchase. But at the same time, it's really important that we understand before we sign that contract, because that contract, it's legal. And if we breach that contract, then we can get ourselves into trouble with the bank, and we can get involved with the court system. They can garnish our wages. So to avoid any surprises, it's really important that we understand what we're signing before we can get in trouble and not understanding fully what we're getting ourselves into. It's really also important that we have in mind of creating a repayment plan. So yes, just because they give you that 5-year loan doesn't mean that you're gonna get stuck with that loan for 5 years. You can always make your personalized repayment plan. Is like, okay, maybe if I add an extra payment, I can lower it to 4 years. But that's really up to you. Now, with the credit application process, I know with the pandemic and with COVID, it sort of has streamlined that process that you could do it online. You really don't even have to walk into a bank to start that process. So usually with the loan application, you can get pre-approved or pre-qualified. And that's just sort of to kind of let the bank know what type of information they're going to seek. So the more information you can supply to them, the more realistic offer they're going to give you based on, based on your credit score. They want to look at, how much you're going to pay in interest rates. The lender then is going to determine different factors. So each lender is different. They all have kind of their own requirements, kind of their own threshold of the credit scores you need to have. So it's really important that we shop around, because all different lenders require different things. And when we are shopping around, maybe one may be perhaps more to our advantage than the other one. But we won't know that unless we do so. So then the lender can decide based on what the information they gather from us, whether one, they approve that loan or whether they deny that loan. And so if they deny it, you get an adverse action letter. Again, it's going to be legally binding document or contract. So it's really important that we pay as agreed. When we, once we get approved, then the bank sends information to those credit reporting agencies. So this is the 3 big companies, and the information they send is, yes, this person is paying on time and they are all current with their bill payment. But what happens if we are late? If we are late, then they send that negative information that goes into our report. Now, I know this may seem like common sense of places to borrow money, but we have traditional banks, we have credit unions, and we have online banks. So all of them have great services, but it's really important that we kind of shop around to see which one will give us the best offer. So if you have been kind of loyal to a bank for 10 years, 5 years, that doesn't mean that they're going to offer you the best interest rate. So that's where we have to kind of, what we have control over is shopping around, and that is how we can in the long term save money. Now we're going to talk about the 5 C's of borrowing money. So the 5 C's of credit. So this is kind of from the lender's perspective. So the first one is going to be character. So this refers to credit history. So we all have, or we build credit history by borrowing money or getting or opening a credit card account. So this credit history is added to those 3 reports that we have. So we talked about Equifax, TransUnion. These are also known as credit reporting agencies or credit reporting bureaus. And you can obtain your credit report at annualcreditreport.com. And so that's the only website. Please avoid just Googling a free credit report. Majority of the time there will be a scam. So make sure you go to annualcreditreport.com. And it's really important that you get a copy of it. You see if there's any mistakes, make sure that you correct them. So bills that are reported to that are credit cards and loans. So any type of loan, whether it's auto loan, personal loan. And then the bills that are not reported are rent, utilities, cell phone, internet. Those bills are not reported on they don't build credit history. So it's really important that we at least open one credit card so that information can provide that on our report. When making a major purchase, how soon do you check your report? So, A, when the lender checks your credit and when you apply, or you do it 6 weeks prior or 6 months in advance. So it's really important that we at least do it 6 months in advance. Again, it could really take a while to make corrections to your credit report, or if you really want to improve your credit report or that information that goes on there, you have that flexible time. So this is 6 months in advance prior to applying for that credit card or applying for a loan. Now with character, it also refers to the credit score. So the credit score is, that number is based on the information that they find on your credit report. So it's really important that making sure that everything's correct in our report so that it gets reflected on the score. So the score is just, it evaluates, how the risk of you being at default for a loan. So let's say the range for that score is 300 to 850. So the lower the score, that means we are at high risk for not repaying that loan. And then the higher the score, it means that we are at low risk because we are paying our debt on time. Now there's a good score, it's 670. Then there's a very good score, 740. Now all lenders will have sort of their kind of threshold or their limit of you need to have this credit score before we approve you for that loan. Now with the credit score with FICO, there's 5 factors that determine that score. Now, FICO doesn't really tell us exactly what goes into that formula that gives us that 3-digit number, but they give us a general idea. So here we have 35% is payment history. So 35% of that information of payment history makes up that credit score. So that is a big chunk that we have control over. So making sure, again, that we're paying things on time. And if we know we're going to get into financial trouble, let the bank or the lenders know ahead of time. Because again, that negative information will go there. And so that's going to ding your credit score. The next one is 30% amount. So this is the amount owed. So that makes up 30%. So this refers to, they look at the original amount that you borrowed and how much you have outstanding on that balance. So if you have the original balance of an auto loan, maybe 5 years ago was 10,000 and now it's 3,000. That's how they kind of compute that. But also another important factor is if you have a credit card. So they're going to look at how much are you using of that total available credit limit. Then 10%, that's new credit. So this is called also a hard inquiry. Anytime that we apply for credit, the bank is going to look at our credit report. And when they do that, it kind of has that inquiry section. So making sure that if we are really taking that credit, or we are really serious about taking that new credit, that we do so. But otherwise, if we are not going to take it, please kind of avoid doing that, because then your credit report will reflect that and it's going to ding your score by 10%. Granted, that's not a lot, but that could be a difference between having double-digit interest versus single-digit. 15%, so that's the length of credit history. So they looked at the account that you had. This is kind of specifically for credit cards. So the first credit card that you open, and also they average that among all of the credit cards that you have. Then 10%, that's a mix of credit. So credit type means having a credit card and also an auto loan. So the auto loan is considered an installment loan and the credit card is a revolving credit. So that's what it refers to, a mix. So here, what's important, that 35% is payment history. So that is going to be one of the key factors to help improve our credit score. Now, with FICO, there's more than one credit score. So we all have more than one credit score. It also depends on what you are financing. So whether that's a car or perhaps you're getting a credit card, they may have different ones. Now with banks, they use outdated FICO scores. So it's really important that we shop around, because maybe bank one is using an outdated one, then bank number two is using the updated version of it. So perhaps one of them could benefit you more. Now, this is just to show you the high cost of low credit. So let's say this is just an example. We're buying a 10,000 car loan. In 48 months, we agreed to pay it in full. So we have two individuals. So one has a score of 580. So this is called a subprime credit score. It's a prime because it's considered high risk for not repaying that loan back. And here, just because we have a low credit score doesn't mean we're going to get denied for that auto loan. It just means we're going to pay more for it. So in this scenario, we have the first individual, the interest rate, or the APR, is the annual percentage rate. It's 17.54%. So that's double digits, and it's really going to pay, we're going to pay more in interest, about, less than $4,000. So that's a lot of money. So in total, it's going to be over 14,000 for that car. Next, we have the individual number two. They have a credit score of 720, and the interest rates that they get is single digits. So here it's just about 5%. And the cost that they're going to have to pay for that loan is going to be significantly less. So that's just, 1,000, a little bit over 1,000 that they're going to owe on interest alone. So here sometimes it's really difficult, because to improve our credit score, sometimes it could take 6 months, sometimes it could take 1 year. Sometimes we just don't have the luxury to wait around for our credit score to magically increase. But what we can do is, anytime that perhaps maybe we can go to a different model or a different year that's a little bit less expensive, or perhaps we can have a bigger down payment. So when we have a bigger down payment, we're going to borrow less, hence we're going to pay less on those interests. And about 25% of auto loans fall into that subprime category. Capacity is the other C. So this is, how much can I afford? So lenders kind of do their due diligence, and they ask you, okay, what type of monthly debt do you have? And so they have this financial ratio. It's the debt to income ratio. So here they try to figure out, okay, how much is your monthly income, and what percentage of that is going towards repaying debt? And here, the bank does it. I know the debt to income ratio, that's for mortgages, but you can use that for yourself and to also set your own debt limits. So here we have a short video that talks about the DTI. Again, this is for mortgages, but that doesn't mean that we can also use it for any loan that we are seeking.
If you're looking into buying a house, ConsumerFinance.gov can help you navigate the home buying process and understand any new financial terms you encounter along the way, like debt-to-income ratio, or DTI. So why does a debt-to-income ratio matter? Your DTI is all of your monthly debt obligations divided by your gross monthly income, which is the amount of money you earn before taxes and before any deductions are taken out. This percentage is one way lenders measure your ability to manage payments you make on money you've borrowed. It may affect how much a lender will loan to you, the interest it will charge, and what you feel comfortable spending on monthly mortgage payments as part of an overall budget. Different loan products have different DTI limits and lending criteria, and the same is true for different lenders. So it's important to look at all of your mortgage options and talk to multiple lenders to choose the loan that's right for you. ConsumerFinance.gov is your go-to resource for clear answers to hundreds of financial questions. To learn more about buying a house and choosing a mortgage, check out ConsumerFinance.gov/buyingahouse. If you're looking into buying a house,
So this is kind of the DTI. So the guideline, if you're shopping around for a mortgage, is to have a DTI of 43% or less. Now, this is just a guideline, it's not set in stone. This is just to see where you are. In general, so let's say we're wanting to get an auto loan, making sure that our current debt is less than 30%. And so I have a worksheet that you can plug in your numbers. It's a PDF. You plug in your numbers and it gives you that percentage. But you can also figure that on your own. So it's you add up your total monthly debt payment. So out of all of your any type of loan that you may have, any credit cards, you add, how much do you pay in a given month? And then you divide that by your income. Now, there's a lot of formulas that do it by your gross income, which is before taxes are taken out. But I think it's more realistic to do it with your net income because that's the income that or the cash flow that's coming in either biweekly or monthly. So again, that's just, how much of my paycheck is going towards debt. And so that guideline can really help you answer, maybe I need to wait 6 months while I try to repay my current debt load. So next time that I go to a lender, I have a higher chance of getting approved for that loan. You can utilize online calculators. Here I just have two, but that doesn't mean, these are the only two resources. There's a ton of resources out there. Like I said, Edmund, so that's a really great website. If you're specifically looking for an auto loan, you can really estimate how much it's going to cost you within a given month and then in total throughout the life of that loan. Then I also like to use PowerPay. So this is with the University of Utah, where they created this software or this program. And so you can plug in your numbers, on perhaps maybe you want to repay down debt and you have 3 credit cards. And so here you can kind of play with different scenarios. Okay, if I focus on one credit card, how long will it take me to pay that off? So I really like that one because you don't get any advertisement from different credit card companies. The debt to credit ratio, this is really important because it also makes up about 30% of that FICO credit score. So here I have an example. So let's say we have, I have two credit cards, 2 credit cards with a credit limit of 1,000, and I have a balance of 300 and 500 in another one. So to get that ratio, I would add the total balance divided by the total credit limit. And so that will give me 35%. And the guideline is to use less than 10% of your total credit. And that will help increase your credit score instead of decreasing that because you're using too much. But let's say sometimes with credit card companies, if you have them inactive for months, what happens is that they close it. And so let's say the credit card company closed my credit card account. So now I have less of that credit limit that I can use. So now it seems that I'm overusing too much credit. So that's 50%. So this is going to decrease my credit score because it just seems that I'm using too much of the total available credit, or that I'm getting close to maxing out that credit limit. So it's really important that we set notifications, or we kind of do the little math for each of those credit cards individually, so that we set ourselves a limit. Okay, don't charge more than $300 on this credit card. And then if let's say you have 2 credit cards, making sure that you're using the other credit card so you kind of balance that ratio out. Now they're also going to look at your capital. So this refers to your net worth. Now they do this with mortgages specifically, but they also advise to do this at least once a year. So this is, you get a complete financial picture of where you are right now. So that doesn't mean that you're going to stay there, but it just means what are some things that kind of need to take priority for you to have an ideal net worth. So net worth is they take all of your assets. So this is anything that's liquid. So your checking account, what you have on your savings account, retirement account, or if you own a home or any cars. So that, for your auto, you can determine the market value of that. So if you were to sell it today, how much will you get that? So that would be considered an asset. And then the liabilities is anything that you owe. So this is credit cards, any type of loans that you may have, any outstanding debt. And so if you get an outcome that you're negative or positive net worth, don't let that discourage you, because for me, I have a negative net worth, but that doesn't mean that I'm going to stay there. So here we can focus on how can I reduce my liabilities so I can have a positive net worth. So here we're going to test our knowledge about the different types of vocabulary. So we have cosigner, joint account, and authorized user. So a cosigner, so this is going to be C. So this is another person who promises to pay debt if the primary borrower does not. So sometimes when you go to a lender and they tell you, okay, based on your credit score, it's too low, we can't approve you for that loan, but you can ask a family member or a friend to co-sign with you. Now, the co-signer needs to have a good credit score in order for that loan to get approved. Now, there's a joint account. Joint account is B. So this is usually with the credit card that you add another person to that credit card. So the other person has their own card that they can make purchases. And what this one means that both of you are legally responsible for repaying that debt, and then that information goes on your credit report. Number 3 is A. So this is, you can assign somebody else to be an authorized user. They also get their own credit card, but on this instance, they're not legally responsible for debt. So it appears on their credit report and they get that data added, but they're just not liable for that debt. So it's really important that we make sure that we understand that. The last one, or the next one, should I say, it's collateral. So this refers to using the value of a home or a car or sometimes property. It kind of gives the borrower more confidence that if you default, they can repossess your car, they can take your home, and so they get paid, but we also kind of suffer in that. So let's say I have my vehicle repossessed. That means that the bank is going to try to sell the car, and whatever money they make from the car, they subtract that from the outstanding balance that I have on that. And let's say maybe they didn't sell it for a good profit. And so now I have what's called a deficiency balance. So I have to pay that to the bank. And so it's really important that we understand those terminology that's used. So consumerfinance.gov has a glossary where you can kind of look up information or the vocabulary, what does this mean? If this happens, what can they do to me? So before we sign, it's really important that we ask questions. And so this other one refers to the mix of credit types. So credit types, there's 2 types. So there's the revolving or the unsecured debt, meaning that there's no collateral attached to this. So this is a credit card that from a traditional bank or from a store, whether it's a grocery store or a clothing store. Then the second one is installment. So this is secured by a property or an item. So this is a car, a home, and with an installment loan, they have a due date and you know exactly how much you owe every month and how long it's going to take you to pay that off. So anytime that we close a credit card and it's the only one that we have, it's going to lower our credit score for about 10%. Because we're only going to have one type of credit, which is the installment. Anytime that we pay off a loan in good standing, it's going to lower our credit score, but that will be temporary. Again, this makes up about 10% of that FICO score. So we have unsecured debt and secured debt, and so that is the mix of credit types. And it's really important that once we are shopping around to different banks, that we take a look at and compare the different loan estimates. So there's a Truth in Lending Act, and so this requires banks to disclose everything that they're going to charge us upfront. So here they have to tell us, how much they're going to finance the car or that loan that we're seeking, the interest rates they're going to charge us, and any finance fees. So sometimes they have administrative fees. Those type of fees really add up over time. And then in total, how much are we going to pay? So here I have, kind of a scenario to compare loan offers. So let's say we got approved for a 10,000 loan and the interest rates is 10%. So we have one loan A and loan B. So here we have the term. So this is the length that is going to take us to pay off that loan. We have 25 months and 49 months. And the monthly payment on loan A is 450, which is pretty high. But, it's more tempting is that $250 monthly payment. Because it just seems more doable. However, when we look at the total cost of the loan, it's really going to add that kind of extra $1,000 that we're going to have to pay. Because again, when we extend that loan, those interests are really going to be really costly to us. So here, yes, $250 seems really doable and really tempting. But when we consider in total, how much are we going to pay in those interests is going to be significant. So it's just going to add more to that loan. So here, 450, that may seem like a lot initially, but over time, it's really going to reduce how much we pay in total. Credit card balance transfers make sense when the card gives you enough time to pay the transfer debt in full, continue to make new purchases on the card, see the credit score qualifies you for a low interest rate. So the answer is A and C. So a credit card balance transfers. So that is when, let's say I have one credit card that I just want to pay off in full. You have the option to do a balance transfer. So let's say I go shopping for different banks and I found one credit card offer that is really enticing to me. So here I have one credit card and the interest rates is 20%, which is better than having 28%. If I transfer that balance, which is 200 and 500, sometimes banks charge you a fee for transferring that. So it may be 2% to 5%. So whatever that may be. So in this scenario is 3%. So that's $75 added to that transfer balance. Then the banks also give you a different grace period. So within this grace period, they don't charge you any interest. So this is where you can get ahead and pay that credit card debt in full. But it's really important that we take note of how long that grace period is. So sometimes it could be 6 months. So if we have, almost 3,000 that we have to pay off within 6 months, you really have to ask yourself, is this realistic for me to pay off in full within 6 months? Perhaps, maybe, perhaps not. But sometimes they do have different offers that it can extend to 24 months. So within 24 months, is it doable for me to pay off this debt? And so this is where you have to kind of crunch the numbers and figure out, okay, which one would be the better option for me? And so this is where online calculators you can do with NerdWallet or Bankrate.com. All of those are great resources to help us kind of figure out, is this a good option for me or not? Sometimes we don't get approved for a credit card or a loan, and it's not the end of the world. So one thing to to avoid that is to shop around to at least 3 lenders, because when we count on one and then we get denied for that, then it's really easy for us to give up and not try again. But when we apply to 3 different banks, then at least we have 2 more to fall back on. But again, it's not the end of the world, and there's some ways that you can improve your chances of getting approved next time. So this is, you can take this information to help you learn, okay, what are some things that I can improve on? So next time that I apply, I get approved. So anytime that we get denied, the lender is going to notify you with an adverse action notice. So this is a letter that states the credit score that they use, the name of the credit reporting agency. So did they use Equifax, TransUnion, Experian? And you also have a right to a free credit report within 60 days of notice. And you also have, so let's say you saw a mistake on your credit report, and you have the right to dispute that error for them to fix it. Now you have to go through a whole process for that to happen. You have to have documents to support that. And if they found out that there's just not enough information to support that, then that information will remain there. So some things to know, make sure that we are looking at our credit report. So lenders, apartments, insurance companies are going to be looking at our credit reports. So, we ought to be doing the same thing. Again, we can assess our current debt load by looking at the DTI, by looking at the debt to credit to see how much we're using of our available credit limit. And that's just an assessment that we can do to help kind of guide us and better prepare ourselves for next time that we are applying for a loan. It's really important that we comparison shop to at least 3 banks. And it's really important that we also budget. So a lot of the lenders, they're not going to know all of the bills that you have to pay on a regular basis. They don't know how much you're spending on groceries, or if you have other kind of personal circumstances that you're taking care of. So they don't know all of that information. So it's really up to us to determine, okay, this is my max amount of money that I'm willing to pay for an auto loan in a given month. Now, these are just some things that we can gather information to kind of help us feel more confident that we're making the right decision. Now I have some credit card basics. Now credit cards are really a good tool to help build that credit history that goes on a report. And so that information is going to help us, either lower or improve our credit score. So with credit cards, any statement that you get in the mail, they have what's called the Schumer box. So this was passed, a credit card act that was passed in 2009. So banks and lenders are required to state, okay, this is the minimum amount due, and if you pay this minimum, it's going to take you X amount of years or X amount of months to pay that the full credit card debt. So it's really important that we, anytime that we have a chance to provide more than the minimum, is going to really help us in the long term. Because when we are just paying the minimum, it creates sort of that illusion that we're creating a dent in our debt, when in reality, those interests are really compounding on a daily basis. So let's hear this video that talks about paying the minimum.
On the hottest day of the year, Marta's air conditioner broke. Marta decided it was an emergency, so she went to the store to buy a new air conditioner. Marta didn't have enough cash, so she used her credit card. The air conditioner cost $300. That evening, her family was cool and happy. The next month, Marta got her credit card bill for the $300 air conditioner. Marta had it in her budget to pay $15 each month until she finished paying for the air conditioner. $15 was her minimum payment. Then, every month, Marta sent the minimum payment. But Marta's balance didn't go down $15 each month. The credit card company added interest to her balance every month. The annual interest rate on Marta's credit card was 23%, so the credit card company added interest to Marta's balance every month. It took Marta more than 2 years to pay for the air conditioner because she paid only the minimum payment. At the end of 2 years, Marta had paid $382, $300 for the air conditioner, and $82 in interest.
So this kind of trivia question. So if we are late on a credit card payment, the bank or the lender could do which of the following? So they can do all of the above. So they can reduce your credit limit. So this is going to impact our credit score. They can increase the interest rate up to 30%. So that's the limit or the cap amount. And they also report that negative information that goes on a report and stays there for 7 years. And they can also close our account. So if we are late, making sure that we are contacting our lenders and talking to them. So what's considered late is, 30 days past due, then that information will get reported. But let's say, within 2 weeks you figure out or you come up with the money to pay the bill, make sure you contact them so they avoid sending that negative information to your report. Now, I wanted to talk about some of the credit trends that we are seeing right now. So a lot of, about 62 million people had their credit limit reduced or their account closed. So it's a lot of people that are seeing different changes. And so again, this does have an impact on your score. So when you are getting an auto loan or a credit card, you're going to see that impact. And the average adult owns about four credit cards. Now, granted, sometimes having a lot of credit cards is really hard to keep tabs on which one, what bill do you have on which one, and making sure that you have just enough credit cards that you can are able to handle. And about those four credit cards, about 25% of those accounts go unused. So this is, again, if you don't use an account or if you don't use that credit card or if you haven't charged anything to it, then the bank or the lender can close that. And of course, that does have that impact on your credit score. And then 1 in 3 said that they had their credit limit or their credit card closed. So this next trivia question. So let's say your wallet was stolen and somebody used your credit card and they charge $1,000. And you see that on your bank statement. So how much are you responsible for? So I guess this depends on when do you report that. And so under federal law, there's consumer liability for purchases you did not make on a credit card is $50 if reported within 2 business days of when that purchase happened. So here, making sure that we don't delay. So if we see something, or sometimes you can put notifications on with your bank, depending on which one you have, if there's an account. I know I have one where if it's more than $100, it will notify me. So making sure that you're using those alerts and that you're checking your bank statement. Now, if you use a credit card, or I should say a debit card, it has the same protections of $50 if you report it within 2 business days. But with a debit card, they have access to your checking account. So they have access to your money directly. And it's really important that you anytime that you have the ability to use a credit card, that you use it, especially if you're getting gas or you're going to different stores, because you never know if somebody's going to, kind of steal that information. Now we have, I wanted to talk about a little bit about alternative credit. So this is, if we don't, sometimes when we have a low credit score or we don't get approved for that loan or credit card through a bank, then there's the option of alternative credit. So it's called alternative because they don't even look at your credit report. They don't even look at your credit score. And these companies are not regulated by the bank. So a bank, a lender, credit card companies are regulated by the Federal Reserve. But with this type of companies, they are not. So it's really difficult to kind of get a hold of, how much fee, to cap the fees that they are charging, to cap the amount of interest that they're charging. So let's go over this ones. So for number 1, it's auto title loan. So this is where you kind of use your car to secure that loan, and is usually based on the market value of your car. And so here, if let's say we don't have the ability to pay that loan, then the car is repossessed and we still owe on that loan. Number two is a bounce protection loan. So this is kind of a term used kind of years ago, and now it's known as overdraft protection loan. So here, overdraft fees are charged until we have a positive balance on the account. Number three is pawn shop loan. So this is where you kind of pledge either a personal property, and based on the value of that, they will give you that loan. And payday loan, so this is where it's secured by your paycheck. So even if you don't have the ability to pay them within 2 weeks, they will take that amount from your paycheck. And then we have number five, refund anticipation loan. These are really popular whenever there's income tax season, where you can get your refund today. Why wait 2 weeks? And you're actually taking the loan against your own refund. And number six is the rent to own. And so this is, you're renting an item for a period of time before you are able to pay it in full. Now, this may seem really doable, but let's say there's unexpected expense and you didn't have the ability to pay that furniture company. Now they can take away that furniture and then you still owe on that amount. So again, these are really, if we are going to use them, we have to make sure that we understand what we're getting into, because it could be more expensive than charging it on a credit card. So I have this other trivia question. So what do you think it would cost a $300 payday loan over the course of 1 year? So typically with payday loans, they are a small amount, usually $200 to $300 or $500, and you have to repay it within 2 weeks. But what I have noticed is that people don't have the ability to repay them within 2 weeks. And so they roll over that amount within the 2 weeks, and then 2 weeks becomes months and months that they have to repay that loan. And now they owe so much on fees and also on interest rates. So here the answer would be D, over 2,000. So I have this infographic. So here we have the original amount that we borrowed, plus any interest, plus any late fees that they add. And so here they show that it's rolled over to 2 weeks, and then it just adds to months, and then we owe over 2,000 initially for that $300 loan. Now in Colorado, they limit how much payday loans can charge us for interest rates. Previously, it was 129 on the interest rates that people would pay. So that's a lot of money. So here it's where it's difficult. With payday loans, they're not overseen by the Federal Reserve, unlike the credit card companies that they are capped at 30%. So they can't charge more than 30%. And so it's really unfortunate that payday loans even exist today, because they're just really predatory lending practices. I did want to have a slide on bankruptcy. So bankruptcy was established as a second chance. So, everybody deserves a clean slate to start their financial life. So there's two that we can file as individuals. So there's the Chapter 7, Chapter 13. But even with bankruptcy, there's a lot of debt that we can just completely wiped out or forget about, such as federal loans, any taxes that we owe, or any child support. So here I provide some resources if you would like to read more information about that. So as you can see, with loans, with the vocabulary, sometimes it can be really convoluted. And even for me that I teach this, it's even complicated, and sometimes I don't understand all of the terminology. But here is, we're not alone, and we can ask questions either to the lender or seek out other information. So here I provide a resource from the Association of Financial Counseling, Planning, and Education. So you can talk with somebody over Zoom. It's at no cost. And this is really to help you be more comfortable in talking about your finances. And sometimes it's okay if we don't know or don't have all the answers. We can always try to find that, whether it's talking to somebody or even doing our own research online. Then the second one, resource, is the National Foundation for Credit Counseling. So this is really if you want to have a repayment plan about your credit card debt or how to manage or consolidate debt. They are also a great resource. Now with this, they do charge a fee to get help with managing debt. But sometimes that fee may be worth it if it's really going to help you figure out your finances and kind of take control of those. So the consumerfinance.gov, like I said, has a ton of great information, great handouts that can really provide step-by-step guidance of getting your stuff ready before you go to a lender. Thank you so much. And for the kind of sticking around, and I hope you were able to take away some information that can really help you prepare next time you are seeking a loan or any type of credit.